Hey guys, what's up, how's it going? My name is Rob and welcome back for another video on the channel. In today's video, we're going to be talking about QYLD, and I'm going to be giving you guys my opinion on whether or not I think this covered call ETF is a good option as you approach retirement, or if you just need passive income. So a couple days on my channel, I did a video talking about passive income going into retirement, and inside this video I focused on two funds, and that was ZWC for Canadians and QYLD for Americans. And these are two basic high dividend covered call ETFs, and that video did really good on the channel, so I figured it'd be a good idea to maybe jump a little bit further into an ETF like QYLD, which is super popular amongst passive income investors, and kind of dive in, look more about the holdings inside the ETF and kind of understand how it works, but also kind of more share my thoughts about whether or not I think this ETF is a good investment, and what type of investors will benefit from this type of investment. Now let's be honest, the big reason why people get excited with QYLD is because of the 12% dividend yield, which is absolutely crazy. As a passive income investor, this looks pretty attractive. So that's probably the biggest reason why people like it, the huge yield, and it does get paid on a monthly basis. So let's jump aside a little bit, let's take a peek at the ETF and let's kind of do a quick little overview. And I also want to mention really quickly, throughout this video, I'm going to be giving you guys my recommendations of whether or not you should invest into this ETF. And I'm also going to be comparing it to the S&P 500 to give you an alternative depending on what your goals are as an investor. So quick little overview of QYLD. It is the Global X NASDAQ 100 covered call ETF, currently trading at $20 USD on the market at the time of doing this video. And QYLD is a high income fund focused on monthly distributions, giving you that high quality 12% yield. Now, we're going to dive into some of the stuff here on the fact sheet to kind of go over some basics of the portfolio, or the fund, if you want to call it that. The net assets is $6 billion, so it's a pretty large fund. The total expense ratio, the MER that you're paying for, is 0.6%, so it is a little bit on the higher side, but keep in mind most of these covered calls do have a little bit of a higher fee for management, because you do have active investors actually managing the fund. And this is why I do like the ETF, because you don't have to do the work for you. You have a team of people kind of doing the covered calls and doing all that stuff for you. You just have to click a button and buy the ETF on a regular basis. And there's a nice little summary here that kind of gives us an idea of what this QYLD ETF does. And it basically follows a covered call buy or write strategy, in which the fund buys the stocks in the NASDAQ 100 index and writes or sell corresponding call options of the same index, and that's how they make the money on a monthly basis. And by the way, at this point in time, if you guys are enjoying this video, be sure to smash the like button and subscribe to the channel if you guys want to see more passive income and dividend investing based YouTube content. In summary, QYLD sells covered calls to basically generate its distribution yield that it pays to investors on a monthly basis. Now, I'm not going to talk too much about covered calls in this video because it's a little bit of an advanced topic inside this video. I'm going to focus on the fundamentals and the basics and how beginners can help to understand this. But what I will do is I will link to the fact sheet in the comment section of this video, where they underline and they help explain the process of how they do the covered calls. And I'll also link to another YouTube video that will explain what covered calls are, that can probably do a much better job than I can explaining how they work. But just understand that the ETF basically writes covered calls. They expire every 30 days, and when they write and they sell them, that's how they generate the distributions that go with the fund. And because QYLD writes a large percentage of the underlying holdings in these covered calls, it has that higher yield. If you look at an ETF like ZWC, they don't write as much as the holdings as a percentage in these covered calls, so it's got a little bit of a lower yield, but you'll see more of a consistent stock appreciation and whatnot, or more level head without more dips and whatnot. So we're actually going to jump inside that part of this video, and let's kind of overview, look at the stock appreciation. Let's see the growth of this fund and compare it to the S&P 500. Now let's spend a little bit of time talking about the holdings inside this underlying covered call ETF, because it is important to have good quality stocks even in a covered call ETF. So the holdings we have here are actually some pretty good quality companies, a lot of tech-based companies, as you guys can see: Apple, Microsoft, Amazon, Tesla, Google, Nvidia, another Google, Meta, which is Facebook, I guess now, Adobe, and it kind of just goes on, a lot of tech-based companies. So the one thing I do like is these are good quality companies. Keep in mind, we are kind of a little bit limited on the different diversifications inside this covered call ETF, but at least the underlying holdings are pretty good quality. And if we compare this to a S&P 500 Vanguard fund called VOO, it's one of my favorite funds, we can see that there's a lot of similarities. So we have Apple, Microsoft, Amazon, Google, Tesla, Facebook, Nvidia, a lot of tech companies as well. So the underlying holdings inside the QYLD, even though they're very limited and there's not as many holdings, they're good quality stocks, just a little bit more weighted towards the tech side. But this is basically the underlying holdings, and I'm a big fan of kind of what they're at least showing us here, and at least it's good quality stocks. Now, the next part of the video, we're going to be focusing on stock appreciation, because this is an important part of investing. One of the biggest ways you're going to make income with the stock market over time is going to be from the value of your stock is growing over time, which is called stock appreciation. Now, it doesn't matter if you're a growth investor, a dividend investor, you're going to benefit from stock appreciation. And I think it's important that everybody focuses on this because it adds so much flexibility inside your portfolio. And you're going to see it probably the biggest con or the biggest issue that a covered call ETF like QYLD has is the fact that it lacks flexibility. And we're going to kind of expand upon this as we go through this video. So the first thing we're going to focus is on stock appreciation. So this fund has been around since the beginning of 2013. And if you look at the stock appreciation from then to now, we can see it's actually negative 17% all time. So as a long-term investor, you're kind of going to be kind of locked into this fund, and you're not going to get much stock appreciation. So if you don't care about stock appreciation, that's fine. But I just want to highlight that, and it's important that, if you're a beginner and you're getting kind of, you get attracted by these high dividend yields, that you understand the risks with a fund like QYLD. Now, if we can compare the last 5 years in terms of stock appreciation, we see a negative 10% for QYLD. And if we jump over to VOO, we're going to compare the max return of Vanguard, the Vanguard 500 VOO S&P 500 fund. You guys can see that it's done absolutely crazy all time. This fund has been around since the beginning of 2010, so a little bit longer, but not too much longer. And you guys can see that it's up 300% all time. Now, if we go over the past 5 years, stock appreciation is currently up 94%, which is absolutely bonkers. So you guys can see that the S&P 500 just does offer you a lot more flexibility. And towards the end of the video, I'm going to give you guys an example of what I would do if I was looking to maybe use QYLD as I get closer to retirement, or if I wanted to kind of build a portfolio from scratch and help to use it to manage my passive income. But for now, just understand that traditional funds like the S&P 500 will definitely offer you a lot more growth and long-term increase in value as compared to QYLD, which really just focuses on the distribution yield. In fact, I really want to emphasize the fact that long term, this fund actually has a negative stock appreciation. So just kind of let that sink in there, and just definitely be sure to think about that if you are thinking about investing into QYLD. So obviously, after looking at the data, if you're looking for growth inside your portfolio, especially over the long term, you're probably not going to get it with QYLD. Now, you could reinvest those dividends and you'd also get a little bit of growth from that as well. But if we're looking at maximum growth over the long term, we can definitely see that a fund like VOO or the S&P 500, for example, is going to be a fund that's going to definitely get you much longer growth in the long term. And if you look at the dividend growth rate of QYLD, we don't see a lot of dividend growth either. If you look at more consistent or more classic dividend stocks, or even growth stocks, for example, a lot of them will have consistent dividend growth. And that's, as a dividend investor, you kind of want to look for that because it helps protect you from dividend decreases that could potentially happen. It also means that your dividend income will steadily grow over time. If you can lock in a 5 or 10% dividend growth rate every single year, then you're basically earning 5 to 10% gains on any dividend income that you earn. Now, at the end of the day, it's not really a big deal with this fund because we're sacrificing growth for that high yield. And they have been consistent with those dividend payments, so that's a good thing. But just understand that with a fund like this, you're not going to be getting a lot of growth. At least we haven't seen any growth with QYLD over the past 8 years. So after comparing the stock appreciation, the dividend growth, and the high yield of QYLD, we can come to the conclusion that this fund is not really a growth-based fund. You're not looking to earn a lot of growth from this fund or really have this investment grow a lot over time. What you're looking to do is generate high passive income, and that really is what this fund is for. And my recommendations for most investors is that, and here's kind of like a good rule of thumb to understand with some of these high yield covered call ETFs, is that if you don't need passive income right now, you're probably better off investing into a more growth-based fund or traditional fund. Now, if you do like passive income, you're approaching retirement, or maybe you just would feel comfortable earning an extra $500 or $1,000 or maybe even more per month, and that can benefit you, then investing some of your portfolio into these covered call ETFs can definitely help you out and can definitely be valuable. But just understand that you are sacrificing growth to get that passive income right now. So really, you just got to ask yourself, if you need the passive income and you can get value from passive income, then investing into an ETF like QYLD makes sense. But if you don't need it right now, you might want to consider investing into a traditional fund instead. And if I was to start over completely from scratch, investing in a portfolio and looking to use QYLD to kind of get ready for retirement, or to have an early retirement, or to kind of basically work part-time as I get older and supplement a lot of my passive income with a covered call ETF like QYLD, here's what I would do. Alright, okay, so I'm going to be using an investing calculator to kind of give you guys a good solid example of what I would do if I was to start from scratch. And you can kind of alter this depending on what your goals are, but just I'd like to show an example of what I think would be a smart idea to maybe use a covered call ETF kind of as you get started with investing, or over time as your investing period goes. So I'm going to give you guys my example if I was to start off completely from scratch. So I'm 31 years old at the time of doing this video. Still relatively young, but not super young, and I still have lots of room to grow. So if I was starting out from scratch and I wanted to maximize my gains, what I would do is, right now I'm probably not going to be retiring anytime soon. Now I might like passive income and I might want to grow my investments, but I can also benefit from the growth of my portfolio over time. I could always pull from my portfolio as it grows. So what I would probably focus on is investing into a good quality fund like the S&P 500. So we can expect a return rate of about 10% or so, maybe 7 to 10%. We're going to say 10% because the S&P 500 has been done quite well over the past 5 to 10 years, but let's just kind of be, balanced. We're going to go with 10%. We're going to compound that annually, and let's pretend that I'm putting in $1,000 a month. We're going to be aggressive here. You could put more than 1,000, but realistically, a lot of people understandably aren't going to be able to just throw thousands of dollars towards their portfolio each month to have it grow. We got to be realistic. So you could put 500. I'm going to go with 1,000. Pretend like I'm being aggressive here, and we're going to calculate how much the portfolio will grow over the course of about, let's say, 20 years. I'm 30. Maybe I want to retire when I'm 45, 50, maybe around that range, kind of thing. So we could go here, we could calculate this, and after 20 years of investing $1,000 per month and getting a 10% return rate, which we could expect, give or take, from a fund like the S&P 500, we would finish with $718,000. So that's quite a bit of growth. Now, once again, we can look through here, and this will show us by year how much a portfolio would grow. And at some point in time, as I get older, so maybe I hit 40 or so, I might think, you know what, I'm 40 years old, I might not be able to retire yet. But you know what, maybe I want to cut back. Maybe I want to work part-time. Maybe I want to spend more time with my family. Maybe I just want to travel or do other things with my life. I now have a portfolio value of $200,000. So maybe I could take a chunk of this portfolio and throw it into a covered call ETF of some kind. Or, I could wait till I'm 45 or something like that when I have $400,000, and I could pick maybe 25% or 50% of that into a covered call ETF like QYLD and get maybe an extra $1,000 or $2,000 per month kind of thing, still have my growth stocks growing in the background. Or I could wait till, I get to that older age of like 40, 50 or 55 kind of thing, typical retirement, and take like $300,000, $400,000, put that into QYLD. You're essentially getting about $1,000 per month, give or take. Get a good quality income there, and then still keep a couple $100,000 into the S&P 500 that's going to grow. If I was to restart and do things from scratch, that's what I would do. I would focus on growth, and then as I get older and I actually need that passive income, that's when I would invest into some of these covered call ETFs. Alright guys, that's it for today's video. Let me know what you guys think in the comments. If you guys have any questions or if you want to add anything to this video, please do so. I hope you guys enjoyed the video. If you guys did like it, be sure to smash the like button and remember to subscribe to the channel.